Next one. This is called a like-kind exchange, and this happens a lot in the real world. You own rental property and you trade it in for another rental property, or you basically take it, sell it, take the money, reinvest and buy another one. This is called a 1031 exchange. It says when tangible investment or business property, not intangibles like stock, is exchanged for similar property, called a like-kind exchange, 1031, neither a gain or loss is reported unless the taxpayer receives monetary consideration, which we'll call boot, as part of the exchange. If boot is received, a gain for the excess of the fair value over the tax basis of the property relinquished is recognized up to a maximum of the boot received. What is boot? Don't confuse boot with booty. Booty. Don't confuse the two. Boot would be cash or unlike or dissimilar property. It says here cash, unlike property, debt relief, and what that means is relief from debt that exceeds debt assumed. For example, in most of these questions, and when they test them, it says that I'm giving you a property, you're giving me a property, my property is subject to a mortgage of 100, your property is subject to a mortgage of 40, I owed 100, I only owe 40, net debt relief is 60. That's considered boot. So that would get added in to see what my amount is. It says here, has to be the same nature and character, like real for real or personal for personal. No loss deduction. The gain is the lesser of the cash plus the unlike property received or the realized gain. So we're going to use two words here called a realized gain versus a recognized gain. So it'll be the lower of what we calculate as the realized gain or the amount of boot that you received, which would be the cash, the unlike property, and the relief from debt, the debt relief. All right, for example, assume that the taxpayer owned real estate with a basis of $200,000 and a fair market value of $5, and that was exchanged for other real estate with a fair value of $4. In addition, the taxpayer was relieved of a mortgage on the old of $150, but assumed a mortgage on the new of $80. And received $30,000 in cash. Okay, so let's see what's happening here as far as the amounts. Okay, so it says again, the basis of 200 and a fair value of 5. So I have a basis of 2, fair value of 5. This is exchanged for other real estate with a fair value of 4. In addition to, okay, so what we have to look at is what's the fair market value of the new? And that is 400. Plus, how much is the boot that is received? And in looking at the boot, what it's going to be is it's going to be any cash, any dissimilar assets, any net debt relief. So it's going to be cash, net debt relief, and any other types of assets that are received. So in this case, I got $30,000 cash. As far as the debt, I owed $150. The new mortgage, I believe, was $80. So I have net debt relief of $70. So that's $100. Equals $500. That is how much the amount is realized. That's what I have realized. So the amount received. I'm going to take away the book value of the old, which in this case was 200. That gives me a gain of 300. Now, this gain is called a realized gain. Now remember, what are we going to do? We're going to book it for the lower of the realized gain or the recognized gain. What is lower? The realized gain of 300 or the recognized, how much should we recognize? You recognize the lower of the realized or the boot received. So what's lower? 300 or 100? 100. Okay? Now, this is a little different than what we do for book purposes. Because remember when we talked about, it used to be called like versus unlike or similar versus dissimilar. And in financial accounting, they changed the terminology to commercial substance or lacking commercial substance. Kind of remember that? And what we had to do is we had to do a funky formula. What we did there is the following. It was different, but this is for studying FAR. What we say here is we say 1 over 5 is 20%. You recognize 20% of the gain or $60. Because what we say is we recognize 1/5 or 20% of the proceeds is boot. Therefore, you recognize 20% of the gain. That's what you do for financial accounting purposes. We don't care about that. What do you do here for tax? For tax, it's the lower of the realized gain or the boot received. So they'll ask you what's realized or what's recognized. recognized. What's recognized? The lower of the two, $100.